Hello traders, Gary Wagner with the Gold Forecast here. It is the 20th day of October. It is Thursday, and this is the Daily Report. It is 6:30 in the morning here in Honolulu, Hawaii, and currently we have gold, spot gold, trading at $13.43, roughly in that area. It is up today approximately $5 to $6, but we are seeing an interesting pattern. It is the pattern that we talked about possibly forming today, and that is the piercing line in our daily chart here. We're going to talk about what I think this market is doing. Have we actually found a bottom, and are we going to issue a buy signal? All here on today's Daily Report. Traders, the big question on my mind today, and I think on many traders' minds, is have we seen the retracement that we were kind of waiting for, that end of what we are calling our wave 3, which is this predominant wave which has propelled gold up to that record top at 1288. As you recall, what we saw is when it did hit 1288, if we look at this upper channel line, this trend line that we drew in with our Andrews pitchfork, you can see that we did hit superlative resistance right in that area. That, of course, was followed on the following day with this pattern, the engulfing bearish. The engulfing bearish is what caused us to pull profits from our long position, followed by a doji, and then this brutal long sell-off. Now, here's what I'm finding interesting today. When we look at the net change of gold, right now it's up $7.70. That is due to predominant weakening of the U.S. dollar. The U.S. dollar differential has put $17.60 into the coffers of each ounce of gold, while predominant selling is about $10. So they're still selling the market. However, as they're selling the market, the dollar is weakening. But this is what I'm finding interesting. When we look at our straight Fibonacci retracement, and this is our 38% level, that's this line right here. These other ones, this 23, this 38, this 50, come off of the Andrews pitchfork. I'll kind of shrink that in a second to show you. But here's what I'm finding. When we looked at the marketplace the other day, we noticed that it was finding tentative support at that 38 level. We also talked about a 2-day pattern, that pattern being a piercing line. A piercing line is one in which after a defined downtrend in the market, I can say that we've had that. You get a long black candle, we certainly can say that. And then in the Forex, because when the market opens and then closes lower, because it's a 24-hour market, they will then insert the open as the next tick. So they're always going to be very, very close or equal. Now, what I am finding is that if the market then is a red candle, and that red candle moves into the midpoint, the body moves into the midpoint or higher, it's considered a piercing line. Well, this was a very, very long day, so it's not quite at the midpoint, but I do believe it's a very, very significant pattern. Traders, here's how I feel about this particular market and what I'm looking at. In a typical piercing line, you want what's called confirmation. A confirming candle on this 2-day pattern is on the following day, which means a conservative trader will need to wait 1 day before taking the signal. You will have to get another red candle that moves higher up off of that. Now, for that to happen, though, the market would actually have to move back into the 1350 area. Aggressive traders can actually take this call. However, if you do take this call, in other words, implement another buy in the market, you really need to place your stop below this low right in here. So the stop is going to have to be a very, very loose stop back around $1,300. That's really the only place that makes sense because you have such volatile swings. So it's a much higher risk trade, and it's a higher risk trade without confirmation. But Those who have been looking to buy the dip, of course, we got in at 1340 before, we got out at 1365. This is a higher risk trade, but I think that the fundamentals that have been driving this market, quantitative easing, relative weakness of the US dollar, uncertainty in terms of the economic vibrancy, global vibrancy at this current point in time. I think that over time, of course, our economies are going to improve, but I think that right now, as long as we're printing money and we're on a fiat money system, in other words, money, since it's come off of the gold standard back in 1974, really, we have only the faith of our governments to rely on as they print more money. That's all it's being backed by. It's being backed by good faith. It's not being backed by gold anymore. Because of that, I think that it is a aggressive trade, but I am comfortable with issuing a buy signal for aggressive traders off of this piercing line for two basic reasons. The first reason is we did come and we did stall at that 38% retracement level, 1330. That was the number that we were looking for originally. We thought that there was a real good opportunity that if we did see a retracement, which we did here, and we're going to get follow through, in other words, we're going to get wave 5, that this was a fairly logical place for the market itself to find support. Right in here. It has in fact found that. Secondly, we do have a piercing line pattern. And that piercing line pattern, although is only a 2-day pattern, I believe it's a fairly significant pattern and it is a strong pattern. If in fact we are correct, and if in fact this is the beginning of wave 5, I think that positioning ourselves right in this area, looking at 1330 as the low, I am now looking for 1430 as a potential top in the market before we see a major correction. Now, what do I mean by a major correction? Simply put, all markets move in cycles. That's the ultimate belief of an Elliott wave theorists. And in a bullish market, it moves in a cycle of 8 waves. The first 5 waves are what we call our impulse cycle, and that's composed of 3 waves. This is the bottom of C, so this is the beginning of the impulse phase. So we get our first impulse wave, correction, 3, the long impulse wave, correction, and then the top of the impulse phase is that wave 5. Of course, once you hit wave 5, you go into what's called our corrective period, which is typically going to be our A, B, and then our C wave. Now, this completes one full cycle. The idea in Elliott wave is as long as the market remains bullish, this will repeat itself. So what's going to happen is we will then go back into our impulse cycle in which we'll have 5 waves. Waves 1, 2, 3, 4, and then our 5th wave, 5. If that's the case, we can then use our benchmark, which is always going to be wave 1. We use wave 1 to give us an indication of the power or strength of wave 5, because typically, and I underline the word typically, wave 5 is about the same length as wave 1, which is exactly what we saw in this last impulse cycle. That being said, I believe that we've got about a $100 move to the upside. 85 of it is still on the table. So aggressive traders, go ahead, initiate a long position, enter the market. Stops are going to have to start at 1300. Even though support is well above that, I need to keep it loose at the beginning so that if there is some gyrations and the market wants to continue higher, once we see that the trade is correct and we get upside activity, we can begin to trail those stops. This has been Gary Wagner wishing you, as always, good trading, and we'll talk to you tomorrow on Thursday. Bye-bye.
many sights to see.